Hey everybody, this is Paul doing a quick video on June 1st, part of my bi-weekly video series there that I do. So let's do a quick review of the market, kind of see where we're at here, and then I guess we'll just kind of go over everything that happened in May and everything I kind of think might happen. It's kind of hard to tell. So right now, as it stands, market's up for the day. Um, you can see this reflected on my portfolio, obviously. My portfolio is currently reflecting the fact that the NASDAQ is up by a significant amount. I still have a large exposure to tech stocks with BST, BSTZ, and QYLD. I did add NUSI and USI towards the bottom, just a few shares, 32 shares. The bottom was probably for somewhere around May 15th. I'll explain. At least in the Nasdaq, I think the bottom might be in. That's a big maybe on that. But as you can see, I added. You can see that when I added the new C shares, um, and then you can kind of see how the portfolio has been doing at the moment. Um, Maybe about a week and a half ago, BSTZ alone was down 25%, so it's definitely had a nice little recovery. Um, Municipals, different municipal stocks have come back. I also added FQLAX. This is specifically a Louisiana municipal fund. This one will deposit back. It won't reinvest the fund, so this one will deposit back into my available balance. So I just like to have state-specific municipal bonds, municipal funds. So that's kind of what that is. That's just nothing major. And then here's where we're at. So I continue to build up my dividend positions. I re-added Coke, as you can see right here. Um, I was expecting Coke to drop, but just given what I'm seeing, I don't think they're going to drop anytime soon. It would take a full-blown recession and just a panic sell-off in the market for it to drop down to like say the high 30s or maybe upper 40s. So I don't see that happening now, and I wanted exposure. So I pulled back some of my TYLD position here, as you can see. So I pulled back my QYLD position just a slight bit, but it's still more than enough to cover the monthly payments and whatnot that these are set up to do. I was also able to switch providers for like my internet and whatever. So this went from like say 73 down to 30, for example. This went from 134 down to 128. So just looking for savings wherever I can find them, different deals and different companies that are basically fighting with each other to get your business. So you take advantage of that if you find them. Definitely try to get cost savings wherever you can. I did add to this breakdown right here that breaks down the dividends. So what this does, it's basically it takes this top number, or it takes the monthly number here from basically right there. Actually, this number up here, 304, and it divides it by 160. And this is the equivalent of basically taking your, it's like taking your monthly paycheck, for example, and then just dividing by the number of hours that you would normally work in a 40-hour work week. So what I was trying to figure out is how much am I actually making an hour if I was working, for example. So basically, this is kind of what it equates to is if you're working and it's for the state of Louisiana at least, this is the federal minimum wage for if you do like waitress jobs, for example. But this is all passive income. So I thought that was kind of a cool way to display this number for anybody that's trying to figure out, am I ready for retirement? And if I could keep having this amount of money coming in every month, I think I'd be able to retire. Basically, what you want to do is you want to take your monthly number that you have coming in and just divide it by that, right? Or divide it by 160, which is a typical 40-hour work week. So 40, 40, 40, and 40. This does rely, so for this to work, this won't work for a lot of people, but this does rely on this number being kind of consistent every month for this to make sense. The way a lot of people invest is you'll have these big spikes in certain months because you have like big, just big stocks that like to pay out. So if you have just a large position in MO, for example, you're just going to have this large spike in July, and then it'll kind of drop off. So that right there works if you have kind of consistent. It's kind of useful if you have consistent dividends every month. If you don't, if you don't, it's mostly just an average, just to give you an idea of where you're at. So let's see where we're at right now. So what do we got here? So right now, where are we at in the market? Or what's the thesis? What's going on in the market right now? Like you're either on one of two sides right now. So because we did not just keep crashing, so that's because we did not just keep crashing, the market began to put in a bottom around basically about 3,800, give or take a little. So if you go back here to September and you go to the chart, and then you just bring it out, say, to the 1 month. So right somewhere around here. So it was at 38.59. This is the level it was kind of bouncing off of for a while. And then right around here, I think we hit peak. Oh crap. This is just. So we went down and then we tested. And then basically we've been up since then, we've been up quite a bit since then, especially in the NASDAQ. And the reason why is because if we don't get a recession, this is your bottom. So that's how that works. So if you don't get an earnings recession, this is very key. So this would rely on the consumers, just normal people, to keep spending the same amount that they're spending right now, which could obviously change. If everything stays steady, if the Fed stops where they're at or where the market thinks they're going to stop at now, and then also if consumers just keep spending, this is your bottom. So that's the bull thesis. We trade off of this level for a while, for quite a while probably. And most we go is, I think some people are saying, say 4,300. If we get 4,300, that's a good year compared to where we're at. And you can kind of see basically the market kind of ended where it started. Started here, 41.55, and it ended the month basically where we started. Where we started. So 38.10, right in that area, 381, is kind of the bottom for the market right now. If earnings and you start to see a bunch of downgrades and everything starts to go south, that's when we test the very bear case scenario. So right now you have people that are in the 2016, 2018 camp. And what happened in 2016, 2018 is the market did go down, but the Fed backed down. So you have that camp which thinks, okay, we've hit the bottom, we bounce, we move around here, and there you go. Then we have the other camp, which is in my previous videos, which is the slow bleed camp. So we don't get a crash per se, we get a slow bleed. So each time that earnings come in, they come in worse than the previous time that earnings came in. And you get slight downgrades in the market, which is more like the 1973, 1974 scenario. And the NASDAQ especially, the tech sector especially, kind of followed that. The slow bleed where it just bled out for months and months and months and months since basically November until mid-May. And then all of a sudden they decided, okay, we've kind of got a bottom. We think it kind of formed here. And I took a guess. This is just my stupid version of technical analysis. But since I made this right here, just as a joke, because I don't even know what I'm doing when it comes to technical analysis, all I did was take the tops, connect the lines, and I took the bottoms and connected the lines. And you come up with something that looked like that. how much further could the market possibly fall before you start hitting, I guess, like these technical indicators or whatever. And this is like, I don't even know what this is called. This is just a little goofy line that I drew. But if you look at where, like, it was either we were going to fall further until we hit these different support levels or whatever they want to call them, or we bounced off of, say, like other levels, like the 200-day moving average, that kind of stuff. So obviously, as you can see, the market decided it was going to bounce. So from here, we're already up 400 or so points in NASDAQ alone. So that's just a little thing I drew right there, just to give you a general idea of like what the market is kind of doing. Then we have, I made this point right here. This is one point that I made. So this is effectively where we're at right now. Now, this is kind of a goofy way to show it, but this is effectively what we're doing right now. If I could zoom this in, this is just a more extreme version because there's been 10 years of money pumped into this market and just companies buying back their stock and supporting these valuations. It's either you're in the X camp, which is it crashes, we bottom, then we go back up. As you can see, the X camp, as I want to call them, or you're in the O camp. So we're either going to X or we're staying at O. A lot of people last month, mid-month, especially believed we were in the O camp, we were going down to X. If that makes sense. So they believe that this 3960 or whatever right here, like somewhere in this little area, was that's the O, and then the X is down here in the 3200 area, which is basically if you just kind of connect all these little lines, you just kind of get that's where you kind of get that at. That's your big major support level. Anything below that, you get into depression territory, and like you don't want to be in that world. So my logic is basically, if you look at the longer term graph, if you bought at O, then over time you don't even, it's the people that are really sitting on the sidelines right now are the people in the X camp that are trying to time this market. Because there is obviously a difference. There's a 30% difference right here, but if you look at this over time, do you care if you bought at O right here when you're sitting up here right now? Like, do you really care? I mean, yeah, it would be nice to buy that X and get this tiny little bit right here. But if you look at it, that was like 1250. And we're at, what now? 41.29. And the market just turned negative because of probably one of the Fed speakers like to talk and they don't know how to shut up. I'm sure if you look at it, you could probably tell why. Probably something to do with oil. If you get to see, probably bonds. Yeah, you can look at it right here. See this right here? This is why the market just tanked. This right here tells me that a Fed speaker doesn't know how to shut their mouths. You can see it right here. It's very clear as day. This was not doing this morning. So either the Fed started dumping bonds into the market and there wasn't demand. Because you got to remember, the Fed is doing quantitative easing, right? Or quantitative tightening. So this is previously what they did. So this is an interesting little chart that somebody linked that I thought was interesting. This is previously what they did. And if you follow this and then you slap the market on top of it, basically as they wound down their balance sheet last time, the market went basically in this direction until they had to stop, and then the market went up in a straight line. And then we had nothing that happened. They were just buying, and now all of a sudden they're starting to do quantitative tightening again. So right now, you have to kind of look at it. I don't have the details of what they're dumping into the market, but either this right here is a Fed speaker just talking about something. They're like, oh, we're not going to stop at neutral. We're going to go through neutral. And if you want to know what that is, look at my previous videos. But you can see how it just literally just killed the market. The market just died. We were having a nice rally. Well, you can see. As I'm doing this video, you can see how quick it turns on the market. And it updates so fast, E-Trade doesn't even update. You can see it right here. Like, look. So this is either a Fed speaker talking or the Federal Reserve just started dumping bonds into the market and there was barely any demand, so rates took off. That's kind of what might probably happen here. Um, I would have to go on Twitter and like talk, like see the people that actually deal in this stuff because they post whenever there's like low demand or something like that. But you can kind of see what's going on. So right now, they're not dumping 90 billion a month. Um, so another way to check or CMBS. So this is CMBS. These are mortgage bonds. See how this one's down today? So these are the guys who would typically go in there and buy up the different mortgage bonds that the Fed's dumping. And as you can see, it's selling off. And if you go to HYG, this is all the high yield stuff. So high yield corporate debt's not too bad. It could be worse. This is the type of stuff that if it blows up, like if you get a massive sell-off in this is the stuff that will take the economy down with it. So you have to kind of look at these. And then you just kind of go to B and D, and as you can see, they're selling off. So you have to kind of look at the market. So it's either a Fed speaker is basically talking right now that they're trying to like, we're going to tighten, we're going to do all this crazy stuff, or they're starting to dump bonds into the market and the market is having trouble absorbing them. That's exactly what this is. Because the Fed will buy the bonds from the government at whatever rate the government gives them to them. When they go to dump that back into the market's going to demand more yield. You have to compete. And you can literally see, like, this is clearly what's going on. Like, they're dumping bonds right now, and the market is not liking it. So this is the problem with quantitative tightening. Is what quantitative tightening does is if quantitative easing is flooding the system with money and taking the responsibility. So what happens is the banks or pension funds or somebody like that would go in there and buy those bonds from the government to support the debt. Or they would charge a higher interest rate to the government and says, okay, you want us to buy your debt, you better give us a good interest rate. Well, that's not what's been going on. Interest rates have been low. The Federal Reserve has effectively been buying those bonds, holding those bonds. Well, now they're trying to dump all of that into the market. Well, the market is telling the Fed flat out, we want a higher rate. And you can see it right here. Like, this is the problem with quantitative tightening and why everybody is telling you it's going to take down the market if they do it too much. And this isn't even the full amount. They're going to do it throughout the entire month. So this is just your first taste of it. So it's going to be a rocky month probably. It's going to be they're they're trying to dump I think 2 trillion into the market by the end of the year. And that's 2 trillion that would not be invested in the market because that would be banks or whatever that would normally buy stocks, but now they would probably jump in and buy bonds or something like that. They might be forced to. Um, I think quantitative tightening is just a silly policy. The way that the Japanese do it, they just hold it until it matures. That's what they do. They just hold it until it matures, a majority of it. Like I say, especially on the mortgage side, they just hold it. You have your mortgage with the government. But you can tell that they're trying to dump it into the market right now, and the market had an almost immediate reaction to it. And you can see it in the bonds. And this is just how it's going to work. It's like every time they go to dump this stuff, the market's going to demand a higher rate for it, and they're going to do that. Or you got a Fed speaker right now that's just talking and just running their mouths, killing the market for the day. Judging that I'm not seeing a big red headline right here, something about like like this Fed speaker is talking about such and such. This tells me that they're dumping they're dumping bonds into the market. Just so you can see how it's reacting just across the entire curve. So this is your big risk. Right now, the strategy, nothing's changing. As it stands right now, everything here set to where are we at? The only thing that doesn't roll over is this guy right here, but pretty much these are my monthly stocks. They all roll over. They reinvest the dividends. Everything down here, reinvest the dividends. Everything in the IRA and my second portfolio, they also reinvest the dividends. So nothing's changing. We're just gonna have to ride this out. Um, at some point, they're gonna have to just stop. You can just kind of see how it just bleeds the market. It just bleeds the market dry. Like there's just not enough. Like the Nasdaq completely flipped. You can see this was up almost 300 points right here, and now it's down 135. And you can see. So the Fed is gonna push this until it breaks. Unfortunately, um, we got to kind of see what happens, but it's going to be all very data dependent. So we're going to have to look at things like jobs data. Housing data is completely collapsing right now, especially with this right here. You can see it. It's like if you went to buy a house this morning, it was at one interest rate. Now you buy a house, it's at a different interest rate. So quantitative tightening is definitely it's going to be the go-to word for the next few months. And you can kind of see, and it's going to cause a slow bleed over time because you're just pulling money out of the market that would normally be going into the market from banks and different pensions and whatnot. That will now go into the bond market because it's a guaranteed rate of pretty much 3%. You know, guaranteed return of 3% for on a 30-year, and you can kind of see on a 2-year guaranteed return of 2.6%. So, but that's kind of going to be the big word as it stands right now. Once they're done dumping or whatever they're doing right now, the market might actually turn around once some buyers come in. But right now, it's either, this is either a Fed speaker talking, or this is them dumping bonds into the market and the market just not liking it and asking for more, and they're getting what they want. So there you go. But that's kind of what we're watching right now. So the other big thing to watch is oil. Um, some are saying that oil might go up to $150 a barrel, which would be equivalent to about $5.50 at the pump. So we definitely have to watch that. That's going to be until this turns around, and until the Federal Reserve comes out and turns this around, we're not seeing. I don't think we're going to truly see new highs in the market anytime soon. It's going to I think it's going to trade sideways or it might trade downward for the rest of the year. And you can see, like you can literally see, as I've been recording this video. But that's kind of what happens when you're exposed to the market. But I'll keep adding positions and whatnot. So I don't know. Let me know what you think, and then in the comment section. And have a very nice day. Thank you.